Ever wonder what the perfect infrastructure proxy looks like for the Indian market? Meet Action Construction Equipment, or ACE, a dominant market leader commanding a massive 63% share in the mobile crane segment. We are diving into their Q3 FY26 review, a story of resilience, expanding margins, and riding the massive infra boom. The headline this quarter is pure operational efficiency. Despite a slight dip in top-line revenue, consolidated PAT grew by 4.2% year-over-year to 116.4 crore. ACE successfully navigated monsoon impacts and high base effects to deliver profit growth through sheer discipline. Breaking down the numbers, total income stood at 890.4 crore. While that is a 1.6% dip year-over-year due to the rains, we saw a massive 15.1% sequential recovery from last quarter. Profitability is the winner here, with EPS climbing to 9.78 rupees. The real story is in the margins, which hit 18.59%, an expansion of 35 basis points. This was driven by a strategic shift toward higher tonnage cranes and better cost absorption. Even after a one-off labor code cost of 6.4 crore, reduced financing boosted PAT margins to 13.07%. ACE remains the undisputed heavy lifter with a 63% market share in mobile cranes. This segment generated 765.2 crore in revenue, with a strong 20.1% margin. As infrastructure activity resumed post-monsoon, we saw a nearly 10% sequential rebound in volume. Agriculture is the quarter's comeback story. We saw a staggering 88% sequential growth in volume, jumping from 526 units in Q2 to 902 units in Q3. This recovery is stabilizing the top line and balancing out softer segments. ACE is operating from a financial fortress. They are virtually debt-free with a tiny 0.08 debt-to-equity ratio. With 1,091.8 crore in cash and equivalents, they have massive liquidity, a rare and powerful advantage in the manufacturing sector. Efficiency extends to their cash cycle, which is just 19 days. This allows for rapid capital redeployment. Interestingly, they deliberately built up 612 crore in inventory this quarter to ensure they are ready for the anticipated year-end infrastructure demand. Innovation is driving their tech edge, with R&D now focused on next-gen AI-integrated cranes. They also secured a first-mover advantage with clutchless transmission. Strategically, they sold their Romanian subsidiary, gaining 12.86 crore and sharpening focus on India. The macro environment looks incredible. The union budget FY27 has earmarked 12.2 trillion for capex. ACE is the market leader in pick-and-carry cranes, the literal muscle required to build the railways, metros, and roads funded by this massive budget. As of February 3, 2026, ACE has a market cap of approximately 11,273 crore. With an industry-leading ROCE of 29.5%, it trades at a premium to standard peers, but at a discount to high-growth engine manufacturers. Our verdict? Fairly valued for a market leader. No investment is without risk. We are keeping an eye on commodity cycles, specifically steel prices, and the company's dependency on government infrastructure spending. Also, remember that Q2 and Q3 are historically softer due to monsoon seasonality. We ran ACE through our red flag checklist and the verdict is clean. There are no discrepancies between cash flow and profit, debt is minimal to non-existent, and the margin trend remains on an upward trajectory. To summarize, ACE holds 63% market share, has proven resilience in expanding margins, and carries 1,091 crore in firepower cash. They are perfectly aligned with India's 12.2 trillion infrastructure boom. Infrastructure is the backbone, and ACE is the muscle. If you found this analysis helpful, like, save, share, and subscribe at ZinvestZ for more smart investing insights. Thank you.